Do you know what triggers a recession and why it's crucial to understand it? Not knowing how a lack of money circulation can cause job losses and business struggles could have severe consequences for your financial future. Stay tuned till the end of the video to find out more. In economics, a recession occurs when the overall level of economic activity in a country declines for a sustained period of time. This can be caused by a variety of factors, including a decrease in consumer spending, a decrease in business investment, or a decline in exports. When economic activity declines, businesses may struggle to make a profit and may be forced to lay off workers. This can lead to a vicious cycle where people have less money to spend, causing businesses to struggle even more. In terms of the money supply, a recession can occur when there is not enough money going around to sustain economic growth. This can happen when the central bank, which is responsible for regulating the money supply, tightens monetary policy in response to inflationary pressures. Tightening monetary policy can increase interest rates, which can make borrowing more expensive for businesses and consumers. This can lead to a decrease in spending, which can slow down economic growth and ultimately lead to a recession. Recession is a global threat because economic downturns in one country can have ripple effects on other countries. In today's interconnected world, countries are more interdependent than ever before. For example, a recession in one country can lead to decreased demand for exports from other countries, which can hurt their economies. Additionally, many companies operate across borders, and a recession in one country can lead to decreased profitability and job losses in other countries where they operate. Furthermore, the causes of recessions are often global in nature. For example, the 2008 financial crisis was triggered by a housing bubble and excessive risk-taking by banks in the United States. Banks were offering mortgages to people who could not afford them, and then packaging these mortgages into securities that were sold to investors around the world. When housing prices started to decline, many of these mortgages went into default, causing huge losses for investors who had bought these securities. The effects of the crisis were felt around the world, with many countries experiencing economic slowdowns and recessions. Two countries that were particularly impacted were Iceland and Greece. Iceland had experienced a significant economic boom in the years leading up to the crisis, fueled in part by a rapid expansion of its banking sector. However, when the global financial crisis hit, the banks were heavily exposed to the collapsing mortgage market in the United States, leading to their collapse. Iceland's economy suffered greatly as a result, with GDP contracting by over 6% in 2009, and the country had to seek financial assistance from the International Monetary Fund. Greece was also hit hard by the financial crisis, which exacerbated an already difficult economic situation. Greece had been struggling with high debt levels and the lack of competitiveness, and the crisis made these problems even worse. The crisis led to a loss of confidence in Greece's ability to repay its debts, and the country eventually had to seek a bailout from the European Union and the International Monetary Fund. The 2008 financial crisis had a significant impact on India, although it was less severe than in some other countries. India's financial sector was relatively insulated from the crisis, as the country's banks had limited exposure to the subprime mortgage market in the United States. However, India's economy was still impacted by the crisis through its effects on global trade and investment. One of the main channels through which the crisis affected India was a decline in global demand for its exports. As many of India's trading partners experienced economic slowdowns or recessions, demand for Indian goods and services declined. This led to a decline in India's export growth rate, which fell from over 20% in 2007 to just 3.4% in 2009. In addition to the decline in exports, the crisis also led to a decline in foreign investment in India. Many foreign investors were pulling their money out of emerging markets like India and investing in safe haven assets like US Treasuries instead. This led to a decline in foreign portfolio investment in India, which fell from a net inflow of $17.4 billion in 2007-08 to a net outflow of $11.3 billion in 2008-09. The Indian government responded to the crisis with a package of fiscal and monetary stimulus measures, including tax cuts, infrastructure spending, and interest rate reductions. These measures helped to mitigate the impact of the crisis on the Indian economy and support growth. How can the lessons from the post-World War II era of a stable global economy help us to address the economic challenges facing the world today? An extremely stable world economy is characterized by sustained growth, low inflation, and low unemployment rates across multiple countries. Such a stable economy is rare but can be seen during certain periods of history. One such period of global economic stability was the post-World War II era, from the 1950s to the early 1970s. During this time, the world economy experienced high levels of economic growth and low inflation. The Bretton Woods system, which pegged currencies to the US dollar, played a key role in this economic stability. Global trade during this time was characterized by the emergence of new industries and increased international trade. Countries such as Japan, Germany, and South Korea emerged as major exporters, while the US and other Western countries imported goods from these nations. The US also became a major exporter, particularly of agricultural and industrial products. In order to maintain this economic stability, countries implemented policies that encouraged growth and reduced trade barriers. For example, Japan and South Korea implemented policies to promote exports, including investment in infrastructure and support for domestic industries. The US implemented policies to reduce trade barriers, including the General Agreement on Tariffs and Trade, which reduced tariffs and other trade barriers among member countries. However, this period of global economic stability eventually came to an end in the 1970s, as inflationary pressures and changes in the global economy led to economic turbulence. The collapse of the Bretton Woods system in 1971 and the oil shocks of the 1970s contributed to a period of economic volatility and inflation. As per Bloomberg's forecast, India will remain immune to recession. Let's investigate the possible scenarios of why it is so. Bloomberg's forecast suggests that India's economy is likely to remain immune to a global recession, despite the possibility of a recession in other parts of the world. This is due to several factors that make India's economy unique. Firstly, India's economy is largely driven by domestic demand, with a large consumer market that is relatively insulated from global economic trends. This means that even if there is a global recession, India's economy is unlikely to be affected as severely as countries that rely heavily on exports. Secondly, India's government has implemented policies to support economic growth, including measures to boost infrastructure investment, increase foreign investment, and promote domestic manufacturing. These policies have helped to stimulate the economy and create jobs, making it more resilient to external shocks. Finally, India's demographics are also a factor in its resilience to recession. With a large and growing population, there is a constant demand for goods and services, which helps to sustain economic growth. During a recession, it is important for individuals and businesses to take steps to reduce their expenses and increase their savings. This can help to create a buffer against economic uncertainty and ensure that resources are available to weather the downturn. Some specific steps that Indian citizens can take to reduce the impact of a recession include building an emergency fund. By setting aside some money in a savings account or other liquid asset, individuals can create a cushion against unexpected job losses, medical emergencies, or other financial shocks. Cutting back on discretionary spending. During a recession, it may be necessary to cut back on non-essential purchases such as dining out, vacations, or luxury items. Investing in education and skills development. By investing in education and skills development, individuals can improve the job prospects and make themselves more valuable in the job market. In addition to these individual steps, there are also actions that the government and businesses can take to reduce the impact of a recession. For example, the government can implement fiscal stimulus measures such as infrastructure spending or tax cuts to boost demand and create jobs. Businesses can also take steps to reduce their expenses and improve their efficiency, such as by adopting new technologies or streamlining their supply chains. As for the nature of global trade during a recession, countries may take various measures to protect the domestic industries and reduce competition from other countries. For example, they may impose tariffs or trade barriers on imported goods or provide subsidies to domestic producers. This can lead to tensions between countries and create challenges for global trade. In summary, we explored the idea of whether India is recession-proof or not, based on its domestic-driven economy and current economic situation. We also discussed how global trade and economic policies can impact India's economy and what Indian citizens can do to help reduce the risk of a potential recession. Now it's time for you to share your thoughts with us. Do you think India is recession-proof? Why or why not? Let us know in the comments below. And if you found this video informative, please consider liking, sharing, and subscribing to our channel for more updates on global economics and finance. Thank you for watching.